Partnered by Times Influence.
Hello and welcome to Aditya Birla Sun Life Mutual Fund presents Voyage Navigate 2018 powered by ET Now. Now last week we heard from market makers and policy influencers, and this week it's time to shine the spotlight on the tremendous growth possibilities in the equity space as well as the fixed income space. Let's take a look.
Last year, 2017 was a period where the macro was very, very strong. I mean, it was a kind of a Goldilocks scenario for across the world. We have seen inflation was kind of trending down. The ECB was expanding its balance sheet. Even Bank of Japan was expanding the balance sheet. And while interest rates were moving up, they were coming for a very, very low base. So the world GDP growth grew at the fastest pace after almost a decade after the global financial crisis, when we saw the world GDP growth expand by 50 basis points. As we move forward into this calendar year, we have seen some of this macro has started to moderate a bit. We have seen the inflation started to move up. US, the PC, which is the personal consumption expenditure, is starting to move up, but still below 2%. The world industrial production is also moving up. The global composite PMI is also in healthy around 54 or so. So this recovery, what we have seen across global, is something which is improving. And again, this year, after a 50 basis point increase in world GDP growth last year, we are expecting, IMF is forecasting another 20 basis point increase in the world GDP growth. So I think this will sustain going forward. And with the tax cuts in the US, and also with the overall commodity prices and resources prices remaining fairly stable, and with consumption coming back, we expect the GDP growth to be fairly strong. So while the monetary stimulus is being withdrawn, is being eased off a bit, we are seeing a big fiscal stimulus, which is coming in, and that should sustain global growth going forward. And in fact, the earnings growth also for whether it's in US, Japan, or Europe, for the last 4 quarters, we have seen a significant improvement in earnings growth across this. And our belief is that with growth sustaining at these levels and with moderate inflation, we should see 2018 also should be fairly good for earnings growth. And that's what has really excited the market. In India too, I think a similar picture is kind of emerging. The macro, which was fairly good last year, which we presented earlier, is slightly deteriorating, not too much. Inflation, which was low, has slowly started to move up, but it's still pretty much under control. We're not seeing it going above 5% or so. But what has prompted is that the low interest rate regime, what we have seen, has started to move up. We saw the bond yields spike up pretty substantially in the last 3-4 months. It has eased off a bit, but that low interest environment is kind of turning around, and interest rates probably have bottomed out, though we don't see them increasing pretty fast. India had a very stable external environment. I think the foreign crude oil prices benefited India immensely. Current account deficit came down, but it started to inch up a bit. It's still around slightly below 2% or so, but that's something which needs to watch out for. So while the macro picture has slightly, I would not say deteriorated, but has gone a bit adverse, the micro data is looking much better even for India. Other question which is there, people ask whether domestic liquidity will remain. We saw a huge amount of domestic liquidity last year and coming in. And I think it's been around 20,000 crores on a monthly basis for the last 1 year or so. And there be some concerns because of the introduction of the long-term capital gains tax and the dividend distribution tax which was there in the budget. And also because of volatility in the market and the slight correction where domestic investors will move away from the market. But at least the initial indication is belied that in the month of March, while the initial net numbers were a bit lower, but if you add back the arbitrage flows, actually we had 24,000 crores of inflows in the month of March. And even in this current month, the flows are fairly steady. So I think the jury is still out. I think we have to see in this year. But our sense is that we should see the inflows remain fairly strong. They might moderate a bit, but around 15,000 crores on a monthly basis should be fairly possible. I mean, last 3 years, 15, 16, 17, if you look at the earnings growth, Nifty earnings growth has been more or less flat. This year, we have seen a revival of earnings. We are expecting only 1 quarter is remaining now. And the estimate should fairly be what we are looking at, around 8 to 9% kind of a growth in this fiscal year. But next year, we are projecting a growth of around 18%, which is 3 to 4% below consensus, but that's a pretty strong growth which we are looking at. And it is spread across various sectors. It's very broad-based. And finally, I think SIP is something which I thought, let me reiterate, I think it has been something which has done well and wonders, and we've seen a significant increase in the SIP book. And people who have invested at the peak of the market in 2008 and continued with their SIPs for the last 10 years have still seen good returns. While the market has given just around 6% return, Sensex, the investment in a SIP would have given around 11.5% return. And a fund would have given another 2 to 3% returns higher, which has been a fairly good return. And I think the trend, what we have seen, the rise in the SIP volumes, what we have seen recently, is testimony of this, and should be a good way for investors to come in and take care of manage volatility in the equity markets. Thank you.
From equities, it's now time to get a sense of the changing trends in fixed income. Manish Dangi of Aditya Birla Sun Life Mutual Fund shares his insights on the growing opportunities available in the fixed income space.
Growth in the world is doing very well, but over the last few months, you've seen a small slump in economic growth. Now, is this slump, which we've been talking of for the last couple of quarters, that given that the local and the global economy, more so global economy, is in a late stage in terms of economic expansion, at some point in time, there would be some reason, known, unknown, which would actually kill this growth momentum. So, the big question, of course, I think Mahesh also alluded to this, is whether this moderation in growth that we've witnessed in Europe, even in US, and to a certain extent in emerging markets, would it kind of sustain and would potentially deepen in terms of a big, financial crisis or a general economic recession? The answer to that, at least at this point in time, looks to us no. I think there are two big economic blocks which could be under threat right now, given at the stage of economic cycle that they are. One is emerging market and other is, of course, US, which has actually expanded for a good 130 months secularly since 2009. The last year was very, very volatile for fixed income. In this year, so our 10-year track record is that near 90% of the funds are in quartile 1, but in last 1 year was a test of, how kind of we stood up to the challenge of higher rates, particularly in the backdrop of, that we were very, very constructive on interest rate for last couple of years. About 75% of our funds were in top quartile and 90-91% were in top 2 quartile. This is versus 20-30 competitors that, they are 90% of the AUM that industry manages. One of the strategy, of course, did struggle was dynamic bond fund, where, we could not trim risk, as much as we should have in hindsight. But I think we are trying to do our best to lift carry of the fund, and most probably in a year or two you would see most of the underperformance that it's seen versus potentially what you would have earned in fixed deposits would unwind in this strategy also. What's going to be the fate of fixed income if interest rates were to rise? I want you to kind of look at it very, very carefully, that majority of funds, our funds as well as some of the industry funds, actually benefit if interest rates go up. So it's quite convoluted, but that's the way it behaves. That if you look at a fund like a medium-term plan, wherein about 11,000-12,000 crore is invested by you and your investors, it kind of had a carry of 9% or thereabouts, ran a duration of 3 years, and the gross return of the fund was 935, which essentially means that it actually ran a negative duration, so it actually benefited from increase in interest rates. The same thing can be held good for corporate bond fund. The carry was 947, and the final return was more than 947 or 10% or thereabouts. So savings, cash manager, and so on and so forth. So many funds where retail investors have invested, actually they tend to benefit if interest rates go up. We are saying that most probably interest rate will stay stable, but that most of these funds that which we've actually sold a lot to our retail investors, most of them actually benefit because you have these laddered portfolio where where the portfolio mature at a certain frequency and they get reinvested at higher and higher yield. most of the times, active management reduces duration across the board when interest rates are kind of rising secularly. So all of that means that, net, all of you do not get hurt. In fact, you benefit at margin when interest rates go up. Finally, there is this case of asset allocation that Bala talked about. It's very, very important to kind of allocate your money basis, your needs. But I've used this forum over the last couple of years to propagate this strategy called accrual fund or credit fund, because we think it is still underappreciated by Indian investors. But this movement is going on. It's going to become much, much larger than most fixed income strategies over the next couple of years. Typically, as I said last year, these funds run about 2 to 2.5 years of duration. About 30–40% of the funds are invested in AA's and A-rated paper. Very, very diversified, about 100 odd securities across these portfolios like medium-term plan and corporate bond fund. And most importantly, every single year they've kind of averaged 100 to 200 basis point or 300 basis point extra spread over fixed deposits, even after expenses. And we've had these, FY14 was a bull year, FY15 was a bull year, 16 was a bear year, and so on and so forth. Every single year, bull or bear market, these funds have actually out-delivered fixed deposits by, on an average, 175 basis points. So there's a great merit for a lot of you and a lot of your investors to kind of allocate money to this fund class, which is called accrual funds. Thank you.
It's time for a short break here on Aditya Birla Sun Life Mutual Fund presents Voyage Navigate 2018, powered by ET Now. Don't go anywhere. We'll be right back. Welcome back. You're watching Aditya Birla Sun Life Mutual Fund presents Voyage Navigate 2018, powered by ET Now. Now, you've heard about the rapid growth in the equity space as well as the fixed income space, but now it's time to get an outsider's perspective on the booming Indian equity market. Global strategist at CLSA, Christopher Wood, shares his insights at the symposium. Take a look.
Bottom line is the US economy is okay, but the cyclical acceleration hopes are not going to be as strong as people are currently hoping. And because the US equity market was very overvalued when the tax reform happened, while the tax reform will create a pickup in US corporate profits, it's in the context of a stock market which was already very expensive. Meanwhile, US bank loan growth remains pretty weak. That chart of US bank lending doesn't fit in with a perception of a strongly cyclically accelerating American economy. And the US fiscal deficit, because of the rising, because of Trump's aggressive fiscal stimulus, this US fiscal deficit is picking up again, and that's one reason why the dollar has remained weak. One of the big surprises to many forecasters this year, with the US tax reform, with rising cyclical GDP forecasts within the US, with rising Fed tightening expectations, many people were assuming that the dollar was going to be strong. So far this year, however, the dollar has remained weak. My base case, and what I advise investors, is to assume the dollar will remain weak until it isn't. And that has been a big relief for investors in emerging markets, where I would still be overweight emerging markets in a global equity portfolio, because global emerging markets always do better when the dollar is weak. If the dollar was strong, which of course it's not, but if it was strong, we'd be reading much more about concern about dollar borrowing by emerging market corporates, because global dollar extended to non-bank borrowers outside America totaled 11.2 trillion at the end of third quarter 2017, up 93% from the 58.8 trillion at the end of 2008. So there has been a big increase in dollar borrowing, particularly by emerging market corporates, but that only becomes a big problem in my view in a world where the dollar is rallying, which is not the case right now. I have had to reduced my Indian weighting a bit this year, and the problem is fundamentally I have to have more money in China. The other problem with India, it is just quite expensive, but the big saving grace when you worry about high valuations in India is that corporate profits as a percentage of nominal GDP are way off their highs. So corporate profits as a percentage of nominal GDP peaked back in fiscal 2008 at 7.1%. They're now 3.3%. So why this big difference? The difference is that the last investment cycle in India peaked out in fiscal 2008. And the reason profits are relatively depressed on a macro basis is precisely because we haven't had a new investment cycle since. So there is room for profit growth significantly to pick up in India if we get a new investment cycle. The problem, of course, is that we can't point to concrete evidence that a new investment cycle is happening. The best you can say is that the investment cycle is bottoming out. So that's why it's very important if this banking system issue in India is finally addressed, because the key reason why the investment cycle has not been happening is because of the legacy of problem assets in the banking system. And clearly we now have this bankruptcy mechanism, NPL resolution system now being legislated in India. So we now need to see in the next few months if this system works. If these bad assets are cleared out of the system, then the chances grow that you'll get a new investment cycle. So that, I think we just have to wait and see. In the meantime, the big positive of the stock market in India last year was obviously this huge surge in flows into equity funds. And that was a big positive, very important, because foreigners were not aggressive buyers in India because they were allocating more money to China last year. So that's why I think this introduction of this long-term capital gains tax is clearly a risk to the Indian equity market this year, because it might reduce, or probably will reduce, inflows. Otherwise, I think another important issue from an Indian standpoint is the currency. Many people have criticized the RBI for being too tight. Clearly, you now have positive real interest rates in India. But the good thing about the RBI being relatively tight, which is how it is, I think how you can correctly describe its current monetary stance, is that the RBI's relative hawkishness is keeping the currency stronger than it would otherwise be. And that's an important point, because one of the key differentiators of performance between emerging markets this year has been what the currency is doing. And for now, the rupee has remained relatively stable to the dollar. So the two weakest Asian stock markets this year in Asia, Indonesia and Philippines, the underperformance has been primarily attributed to the currency. Thank you.
Further delving into the heart of the matter, executive editor of ET Now, Nikunj Dalmia, sat down to interact with Christopher Wood to understand the growth prospects that are available for India and the way ahead for the Indian financial markets at a time of global volatility.
Good news and bad news always comes together. Whereas you are an India bull, the news flow for India this year has not been great. But I particularly want to quiz you on the impact of the bank scam which has happened in India, and what could that do to stock market valuations?
My Asian portfolio has always had private sector banks in India in it, but the private sector banks are not really, they're partly a macro story, but they're partly a story of taking market share from public sector banks. You would hope that these various scams, ideally, you would like that to lead to more forceful policy to privatize the public sector banks, which would mean reducing the government ownership below 50%. That would obviously be the ideal outcome from a free market perspective, but my base case is that's not going to happen.
Your India portfolio is also dominated towards HFCs, housing finance companies, and you've been running this portfolio for a while now. Some would argue that HFC stocks are crowded, they are over-owned, and when there is a consensus over ownership, the upside for a stock investor always gets limited.
No, it wouldn't be a surprise to me if these particular stocks traded sideways all year, because they had big gains last year, and the gains were triggered partly by the rollout of these policies on affordable housing. But actually, if they do trade sideways all year, it's healthy consolidation. So I don't want to sell them particularly because I don't see any obvious grey area to replace them with. To me, the policies put in place for affordable housing, if sustained, obviously the policies change or should lead to an affordable housing cycle of at least 5 years.
I also noticed that in your model portfolio, you have a very large weightage towards commodities, Indian commodity stocks and global commodity stocks. So what's the underlying thought here?
Now that's based on supply-side reform. So that allocation supply-side reform in China, that allocation will prove to be wrong if the Chinese reverse on their supply-side reform policies. My view is firmly that the supply-side reform policies will continue in China. And by the way, the chief architect of supply-side reform in China has just been made like the equivalent of the economic czar by Xi Jinping. So any Indian company involved in coal and steel especially, or even aluminium, this is just a positive.
What would you say would be your big predictions for this cycle at the current?
No, the two most straightforward stories, apart from continuing to own the best private sector banks, the two most straightforward stories in India right now, I'm talking on a 5-year view. One is affordable housing and everything connected to it, but you do need Mr. Modi to be re-elected because you need the policies to continue. And the second story is to me the dramatic impact of what is known as RERA, Real Estate Regulation Act, which is, in my view, going to lead to dramatic consolidation in the real estate industry, but I think will lead to a vast improvement in the real estate sector because only healthy, properly capitalized companies can do real estate development in the residential sector. Therefore, you want to have long-term investment positions in those real estate developers you believe have the expertise and the balance sheet to profit from the inevitable consolidation which RERA will trigger.
Chris, at the beginning of the year when markets sold off, when we saw that 4-digit dent on Dow on a single day, fear of rising interest rates, they had melted some key portfolios. Parallels were drawn between 2018 and 2008. Were those silly parallels which some global commentators were drawing at the beginning of the year?
Well, I think the parallels are more equivalent with 1987 than 2008.
Oh, that's even more scary.
Well, not really, because it was a bull market correction, but it was a very violent one. Because it was caused by the big problem in the US market is that the estimates are that 70 to 80% of trading is done by machines, which are operating on algorithms. So this is what I call the Terminator effect. And what it means is that every machine sells at the same time because the machines are all running along the same programs. So we've never had a stock market so dominated by machines. And that's what you saw in February. And if we suddenly get a number that makes the market think that inflation is going to be 100 basis points higher than what we think, we're going to get the same thing again.
In 2007, you had given a call that BSE Sensex would touch 40,000. We are close to 34,000 after having touched 36,000. No. Morgan Stanley has come out with a call that the Sensex will go to 100,000 in the next 5 years. Any view on that?
Frankly, I've been wrong. We haven't reached 40,000.
Yes.
And the reason we haven't reached 40,000 is because this investment cycle hasn't come back. The reason I've been wrong is because the government has not addressed the banking system issue as proactively as what I would have assumed when this current BJP government was elected. So actually, while there's all kinds of reasons why they haven't done it, the fact is that means the economy has been slower. But if the investment cycle comes back, then I think that's a reasonable forecast.
Thanks for the lovely presentation, Chris. I have a small question. Now, earning visibility not being there for some time, we have some risk coming from the banking sector and election being, the risk for another year or so. In such scenario, from, near-term perspective, what strategy would you follow?
Well, I think in the short term, the key issue for the market is how this banking resolution plays out or doesn't play out. To me, that's the key issue. But by the fourth quarter of this year, you will have to start to have a view on the politics. I think personally it's too premature to think about that, but I would say from fourth quarter of this calendar year, the politics will become key. If foreigners believe that the current government's going to lose, they're going to be selling Indian equities.
Let's clap together for Chris Wood. It's been great to have him here. And thank you, Chris. Thank you for your valuable time.
Well, those were the key takeaways from CLSA's Christopher Wood session at Voyage Navigate 2018. And that's all the time that we have on this episode. But we'll be back next week with another set of stellar speakers. Thank you so much for watching Aditya Birla Sun Life Mutual Fund presents Voyage Navigate 2018, powered by ET Now. We'll see you again.
Partnered by Times Influence.